Testing. Hello and welcome to the Quarterly Context webinar for the second quarter of 2024 for clients and friends of the Advisor Group. I'm Greg Patterson, CEO. For those of you not familiar with the Advisor Group, we are a wealth and life strategy firm focused on helping business owners and leaders with their financial goals in their personal and family realms, their fiduciary employee support efforts through retirement plans, and their communities through endowments and related to nonprofits they may be involved with. To complement the strategic work we do with clients, our quarterly context webinars are designed to make economic and other information approachable, high-level perspective regarding the economy, markets, and investor behavior patterns to help our personal wealth and institutional clients stay more relaxed by staying informed and to make better decisions towards your goals. The first section is mostly high-level, and section 2 has some additional charts and details for those interested. We'll try to keep this first section to about 20 minutes, and we'll also circulate a video link later should you like to view some part of it again or pass it on to someone you think we can help like we've helped you. If you have any questions, please submit them to the question box and we'll either answer those as we go along or towards the end. As usual, we'll cover some key context items and headlines, economy and market highlights, patterns that matter, some new investor behavior research, some 401k type trends from a recent survey, and a look back on the capital market projections patterns that we hope will be interesting to you. As always, we like to remind clients and everyone for that matter to focus on that space between things that matter and things that you can control. That's where you can have the biggest impact, whether that has to do with planning and preparing for the future, strategic decisions, being a non-emotional investor when markets get bumpy, or other important areas in your financial or non-financial life. The Advisor Group is all about you and providing advice that is aligned with your interests. We have no conflicts of interest, we have deep resources, and we are heavily focused on supporting your needs through our expert team, whether it's on the personal wealth side or the institutional side. As always, there are bits and pieces of news that cause the market to move around a little bit, although this quarter, second quarter, was relatively mild and low volatility. But a good reminder that, as always, that news does not always drive the long-term results, tends to create bumps in the short run and then tends to smooth out over time. In terms of some of the major metrics that we've been keeping an eye on, the 11 consecutive rate hikes that happened over the past year or so, or really 2 years, ending January of 2024, have not been yet followed by a cut in rates. The Fed is being very careful about that, waiting for inflation data. Inflation data has come down now at a 3% average for the year relative to the 9% average of the June of 2022. And the most recent month actually for the CPIU had a slight decrease in inflation. So a small negative number, which is giving the Fed more confidence that the action they've taken to try to rein in inflation has been effective. However, they're still not quite prepared to cut rates. Stock markets were solid, although not quite as exciting as they've been in terms of the strong returns of recent quarters, about 3% for the broad US market and flat to just slightly positive for US bonds, given that the rate environment hasn't really shifted yet. When rates do begin to come down, that will give bonds a bit of a boost. Unemployment has remained about the same. That's been a little bit of a stubborn element that has frustrated the Fed in terms of their willingness to bring rates down. But there is some signs that there may be additional softening there. And the GDP forecasts have also tapered down just a bit, meaning that the impact of the Fed may be taking its course as planned. Certainly the Fed, however, doesn't want the economy and GDP to drop too low so that it actually triggers any kind of recession. Markets, again, solid for the US market. Emerging markets, after a bit of a period of weakness off and on, had a strong 5% return for the quarter. International stocks weaker, global real estate a little bit weak for the quarter, and bonds again flat, both US and international. If you look at the 10-year numbers, you can see that even some of the bumps of the COVID period and the interest rate period did not have a major impact on the overall average 10-year number. That's comforting for a lot of people. The international numbers are a bit weaker, and as we'll see later, and as we talked about before, have relatively more attractive valuations relative to the US market. So reason to continue to diversify, and reason to expect maybe a little more volatility potentially from the US market. On that note, the US market in particular, large cap growth, and within that really mega cap growth, as we'll talk more about in a minute as well, have had the strongest returns. However, even some of the small and mid cap value have started to shine after a period of lagging, even though positive on an absolute basis by a good margin, a little bit weaker than a lot of the other asset classes, but starting to work their way back up. If we look at the long-term patterns here, we can see this is in the larger chart after inflation numbers. So the current market of the global financial crisis, and then the COVID dip, and then the rate dip are far ahead of the three other worst markets. And in the smaller inset chart, you can see that the red line, which was the 70s oil and financial crisis, actually has more of a similar pattern in a lot of ways to the last 15 or 16 years that we're experiencing now, and experienced a higher period of inflation as well. So a few increasingly parallel patterns there. Mentioned a moment ago, large cap growth, and more specifically mega cap growth companies. These are the very large companies that have had over the last number of years relatively stronger results. In a prior quarter, we showed how those stocks through the end of last year had about a 70% return versus the S&P 500, which had about a 6% return. The remaining members of the S&P 500 had about a 6% return. However, that doesn't mean that will persist forever. It may persist for a while, but there tends to be reversion to the mean over time. In any short given time period, as you can see in this chart here, Tesla and Apple, which are part of the Magnificent Seven, some of the largest 7 stocks in the S&P 500, which were hot performers for quite a period of time, have had some hiccups. And in recent quarters, both of these, Tesla in particular, had even weaker results. So dominance doesn't always last forever. This doesn't also mean that either of those companies are down and out. It just means it's a reminder that what is hot and big may not always stay hot. NVIDIA, on the other side of things, surpassed Apple and Microsoft to become the largest company in the world by market capitalization. They went from took them about 24 years to get to 1 trillion in market cap, about another 9 months to get to 2 trillion, and then very quickly got up to 3 trillion. They are the AI chip manufacturer that's got some systematic competitive advantages currently. And that rapid rise in valuation has really led to very strong returns, and has helped drive the S&P 500 return numbers higher than maybe they might normally be. However, there is general concern out there about some of the momentum buying and the performance chasing for stocks like that, and that could lead to a more rapid reversal if there is any kind of bad news. And NVIDIA does have some challenges on the horizon, being challenged in terms of software versus hardware bundling in Europe, and can never quite predict what will cause stock price to come back maybe to its more rational value. Another reminder on the same topic or related is that the S&P 500 and the Russell 3000 are the most concentrated in those large names than they have been since 1999. And as you may recall, 1999 was just before the dot-com crash. That doesn't mean we're in the same kind of environment, but markets are cyclical, and it wouldn't be unusual if there was some cooling. And while some active managers are tempted to chase those really big stocks that have been really hot, that can lead to overconcentration, and that can lead to excess risk. And when we build portfolios, we allow for some of that, but try to dampen that by increasing diversification across managers that prevent that from happening entirely, so that it doesn't entirely happen. The top 5 in the S&P 500 represented 24% of the index recently versus the broad international index, where the top 5 only represent 7%. So and the number of names or companies in the international index, as you can see here, has grown over time. So that actually increases the number of opportunities to find the future fast-growing companies, whereas the growth in the US market in terms of publicly traded stocks has been fairly flat. So a couple of reasons to remain diversified and be excited about the long run about things that are not just the S&P 500. On another note, but also related to recent persistent patterns, value and growth tend to take turns over time in terms of which is doing better. Sometimes those are shorter cycles, sometimes they're longer cycles. In the last 10, 15 years or so, we've had an extended cycle where growth, partly because of those mega cap growth companies I mentioned a moment ago, have been in such strong favor. But after there have been periods where when the green line shows here that it's down, that means that value is relatively undervalued, and then there tends to be a reversal. And then down, and then a reversal, down, and then a reversal, down, reversal. And the dot-com periods was, in some ways, has some patterns that are similar to where we are now in terms of valuations. And the numbers behind this data, which comes from a Vanguard study showing this prediction ratio of when things tend to turn after a period of time, is starting to show that the prediction ratio of value having a bounce back is going up. So for those that are wondering why you're still holding value stocks, eventually you will know why. Eventually those stocks will be rewarded, even though they've done quite well in the very long run, and merits patience. Here we can see stock valuations, the big trends and patterns over time, cycling up around the dot-com period, then back down, then back up, down a bit during the rate period, and now cycling back up. And the US stocks have been higher valuations, more stretched valuations, some would say, relative to other countries and regions, whereas the other countries and regions tend to look more attractively valued, in some cases undervalued. So you can see that here as well. If we look at within the US market, the price earnings ratio, which is a measure of valuation, is at about 150% of the 20-year average. And sometimes when the price earnings ratio gets to that level, or that far above 100% of its average, sometimes there can be some volatility in the wings. Interestingly, we've been talking for a while about how consumer confidence has been rising, with stock market being strong, with housing prices being strong, but now it seems that some of the sentiment around that is being outweighed by the effects of inflation and the effects of some of the little bit of cooling in the job market, and overall savings of individuals after the lower spending period and the direct to individual stimulus period of COVID. Savings has really trailed back down closer to long-term averages. So people are feeling a little bit less flush with cash, a little bit more nervous and cautious, and that may reduce spending, and that can also lead to cooling in the economy. If that happens just a little bit, that can be helpful with the Fed to lower rates, which could then help stimulate the economy when needed. But the Fed wants to be careful not to do that too soon as to inspire additional inflation. Overall, as mentioned, the unemployment rate has been hovering. There's a tiny dip that's not shown here, but essentially flattening out. Wage growth has cooled a little bit. That is something the Fed did want to see so that inflation can be considered more tamed. However, certainly if wage growth continues to cool too much, that can be a threat to the economy and spending. Rates, again, after a historic low period of near 0% rates and then ratcheting up to try to get to more normal levels, then the COVID period happened and it stayed low again, now ratcheting back up. That was tough on bonds and surprisingly not as much of an impact on stocks as people believed would happen, but still some impact. And no cuts yet for the reasons mentioned before. The interest rate levels are projected or hovering this higher for longer idea that the Fed has been broadcasting. There's the expectation there'll be one cut before the end of the year. Some economists don't see any cut happening at all, so we'll have to wait and see. And this chart shows what rates have been over time, and then the projections here are the Fed's projections in blue and the market's projections in green. But historically, the projections have been fairly inaccurate because there are variables in the economy that tend to pop up that tend to throw off the predictions. But it is interesting to see where at least the Fed is hoping or planning things will go absent any unusual new information that might cause the Fed to act differently. Inflation, as mentioned, has cooled down a bit, continuing in the direction the Fed is hoping to see. So that some normalization there, that's good for consumers and also will allow the Fed to eventually lower rates back to a more normal level. The yield curve in terms of interest rates out there in the bond market went up just slightly, almost imperceptibly. And while the yield curve remains inverted, and inverted is when the long-term rates are lower than short-term rates, which usually implies that there is a lack of confidence about the future of the economy in the medium term. Usually when it's inverted, that is followed by some type of recession, although that's not always the case. But now we've been quite a number of months since the yield curve initially inverted, and the economy is doing and the markets are doing reasonably well despite that persistent inverted yield curve. So what does this imply, or what do economists think about the chance of recession? The consensus is increasing around the idea that the Fed's action is working towards leading to a soft landing and avoiding a recession. However, there still could be delayed effects from higher interest rates that haven't worked their way through the economy, so that could lead to some additional economic cooling, and if other variables arise that haven't yet been predicted, still some possibility of recession. But at the moment, it looks like we're dodging that. What could help trigger that? Well, there are some signs that with lending slowing, that kind of destimulative, that's partly due to the higher rates, higher car and credit card delinquencies is also a sign of some cooling and weaker spending, which oftentimes precedes some sort of broader economic cooling, and generally prior to recessions too, but it doesn't always lead to a recession. And not quite immediate term, but some of the longer term effects that could put upward pressure on inflation and rates are the projections of the budget deficit, which is about 2 trillion currently, which is an increase in the forecast of 1.6 trillion a few months back, and is projected to reach almost 3 trillion by 2030. 34. And notably, that's about 7% of GDP, which is higher than the 3.7% of the 50-year average, and higher than the 3% that the Eurozone sets as a maximum GDP ceiling in terms of managing budgets. So that's some things to consider that may have a detrimental long-term impact if not managed more effectively. In terms of investor behavior this quarter, we thought you might find interesting this chart, which shows how often the average investor is right when they are changing their own investment mix. This shows the percentage of people who were correct about their guess. And if you add all these numbers up, it's about 50-50. Shows that people on average, are just about as likely to guess wrong as to guess right. But if you draw a line here from the bottom to the top, you can see that people are decreasingly guessing right. So increasingly guessing wrong, and that can be harmful to portfolios and long-term plans. So a good reminder that having a disciplined plan, a disciplined approach, and a thoughtful process around investing and connecting that to planning can be very helpful and oftentimes more successful than guessing in the long run. Generally, always more successful than guessing in the long run. Volatility is inching down. If you look at the long-term patterns here, when volatility has hit sort of a fairly low, it tends to pick up just because markets are cyclical. Hits a low, picks up a bit, hits a low, picks up a bit, hits a low, picks up a bit. So again, we wouldn't be surprised. There's no obvious reason that would lead the volatility to pick up, but that is part of the long-term pattern. Don't be surprised by that. Don't let that worry you too much. If you've got an asset allocation that makes sense for your life stage and plans, or your endowments, a structure and spending policy, et cetera, or your plan participants, retirement plan participants, investment vehicles that are connected to their life stages, then this is all expected within the long-term planning and investing process. Along that note, in some variables that go into our planning process for individuals and institutions relates to the capital markets asset class projections that we get from Callan Associates and their econometric forecasting group, the quantitative consulting group. And while last quarter we talked about what the updated capital markets projections were specifically, this quarter we thought we'd show you an updated study of how those projections have been effective over time. You can see here that while there are periods of time where the projections in green, projections in orange are a little more stable than the actual, in general, they're fairly close to those projected numbers. Where they tend to stray, if you look at this chart and even farther back, is when there's a major financial crisis of some sort. Those are hard to predict and they happen rapidly, but then they tend to revert to the mean over time. So this may give you some confidence that the numbers that we use for planning purposes in the long run have reasonably high levels of reliability and predictability, which is, again, good for planning purposes, which is the whole idea about developing forward-looking projections rather than just relying on historical returns, which are heavily time period dependent, and the projected returns that Callan formulates consider the past, but also economic variables that are on the horizon as well. In this lower section here, you can see how the actual, this is not a comparison of the actual versus projected, but just show how, as we've discussed in some prior quarters a while back, what the projections have looked like over time in terms of ratcheting down over a number of years, and then now they're working their way back up, and a lot of this has to do with lower rates and variables in the economy. So just some pattern here. You can see by asset class. For retirement plan fiduciaries, a couple of quick notes from the Callan DC Trends study that came out recently. More and more plans are seeking to help keep assets in their plans even after people retire or when people leave. There's an increased sense of responsibility around helping people avoid making poor financial decisions, and it also helps create scale and for those plans in terms of working with and accessing higher quality record keepers, for example, over time. There also, it's a reminder here that the Secure 2.0 Act, which was passed in 2022, had about 100 provisions, so there's a lot going on there. A lot of it wasn't clear and has been awaiting clarification from the DOL, Department of Labor, and some of those items are relevant now, some of them don't come into effect until the coming years. Some are required of all organizations, some are just required of new plans, some are optional. So there's a lot going on there, and that's where talking with your record keeper and with the advisor group, we can help you think through which items you need to think about. Some of that will be automatically addressed by the record keeper for those plans. On this right-hand side is showing how a survey of plan sponsors and what they're focusing on and how they've changed things or planning to change things over time. And it's been a growing number of organizations are using Roth, automatic enrollment, partial distributions, which rather than just a one-time lump sum distribution at retirement, installment payments, which people not only can do partial distributions, but can set it up to get something like a paycheck out of the plan over time to make sure they're spending wisely. Automatic increases, in addition to the automatic enrollment, these automatic enrollment and automatic increases can really have a big impact on savings rates and therefore really big impact on retirees' retirement readiness. So these are the four items that are circled here are the items that we think have the biggest, that we recommend as if you don't already have those in place, to focus on that, to have the biggest impact on your plan participants in terms of your employees and helping them become retirement ready. A number of other variables here are also worth considering, but those are the key items we encourage you to think about at this time. A few more items from the DC study or retirement plan study. This relates to target date fund data. A gradually growing number of target date funds are using both index and active management. That's consistent with how the primary recommendation of the advisory group, which is to use custom target date funds, to have best of breed funds without any conflicts of interest and higher diversification than the off-the-shelf target date mutual funds, generally speaking. And the study also showed that more organizations are using custom target date funds, and the rationale for that, as listed here, to have best-in-class funds, to be able to control and replace underlying managers if there's a concern, rather than having the mutual fund company, if it's off the shelf, have full control over that, and other variables as well. And it's now the case that 94% of respondents offer target date funds. The Callan study focuses on larger plans, so this number is a little lower for smaller plans, but that is the general trend to include target date funds in some form. Some of our clients also use target allocation funds, which can also work very well, pre-built portfolios as well. Gives more flexibility, but also requires that the plan participant be more involved with ensuring that they're holding the right stock bond mix at any given time as they go through their life stages. In terms of the rules and regulations corner, a few items to hit on here. A general item, the Supreme Court ruled that the Consumer Financial Protection Bureau can remain in place. So that may be good from a general standpoint of protecting consumers. We sent out a template email to our retirement plan fiduciaries, and hopefully those of you that received that did format that to send out that to your plan participants, reminding them to increase their savings rates as the IRS limits have have gone up. There's a relatively new fiduciary rule, which is more about managing advice providing organizations or organizations that pretend to provide advice, and not a lot that plan sponsors need to be particularly concerned about, because it doesn't affect them as directly, at least those that are working with us, because we are don't have the conflicts of interest that product companies have, since we are conflict free and sit on the same side of the table as clients and act as fiduciaries. In those cases, plan sponsors have very little to think about and worry about in that regard. One area, however, is it's encouraged is to check with your record keeper and make sure that their communications have changed, because one of the rollovers out of plans, it's now the fiduciary rule makes it harder for brokerage firms and record keepers to do marketing around that, or to plan participants in a way that might not be in the best interest of plan participants. So that's generally good news, and so it can be good for plan sponsors to make sure that their record keepers are communicating appropriately in that regard. No news for foundations and endowments. We do encourage you, if you haven't yet updated your spending policy documents consistent with the spending policy analyses that we conducted with you last quarter. So keep an eye on that and make sure that's consistent and documented for your this next year. A number of new blog posts around 401k, a longer one around our investment process that might be helpful for some of you that are interested in seeing and understanding more of the broader picture of what we do under the hood in the background on your behalf in terms of our investment research, investment committee responsibilities, and how we oversee and make decisions about portfolios and the resources we have and access around that. Hopefully find that interesting. And a number of other posts as well, and the recording for the Gen X Guide to Planning for a 100-Year Lifespan will be posted in the near future as well. That was an interesting webinar, lots of interesting things to think about. So I encourage you to take a peek at that. So I want to thank you for attending. For those of you that are satisfied with just seeing the first half, there you go. We do a very quick run through of the second portion for those that are especially interested in some of the details. So we'll just go quickly here. As a reminder, cash rates are still high in money market and other types of vehicles. If you have money sitting, it's either corporate or personal money sitting in savings or checking accounts, you're earning essentially 0%, while there are near 5% returns available now. That won't last forever. Once rates start coming down, that will normalize a bit, but rates are relatively attractive for that kind of short-term money. Endowment type funds benefit from thinking about things in different time frames. That then connects back to whether with or without a spending policy, different stock bond mixes that are generally appropriate. So this is a starting point for discussion, but something to think about. If you have funds that are, for example, medium term, but you are in very high stocks, or if you have something that's longer term or medium term and it's in almost no stocks, it's time to revisit that and rethink how your timeframes connect to your asset allocation. Some of these numbers are also in prior charts. You can see, for example, the dollar has had some cooling and is hovering a bit. The labor force numbers are interesting to see, where for ages 25 to 54 has been a more rapid increase, where has been a decrease for those that are 55 years and older. Already looked at some of these valuation numbers, but this chart in the lower left shows more detail across a number of indexes and breaks it out between growth and value. So you can see those large cap growth stocks are relatively elevated, whereas value stocks are more normally valued. And in some parts of the world, in some segments, very attractively valued relative to historic pricing, and over the long term, when it's undervalued, that tends to be more upside, and when it's overvalued, there tends to be more downside potential in the short or medium term. We'll just kind of whip through this. The quality securities, higher quality stocks as measured by stronger balance sheets, higher return on investment and other variables, and lower debt are currently doing a little bit better. That's not uncommon as economies cool down a little bit, whereas when things are high flying and money is cheap and it's easy to borrow, the more speculative stocks tend to shine. So this may be a sign that things are normalizing a bit, and this is where having diversification across an array of security types and asset classes can be very helpful in portfolio diversification. As a reminder, these are the projected returns we've talked about last quarter here for your reference. The business cycles in terms of where we are. And a reminder of the 5 steps we go through with all clients. And an interesting study, there's more combination studies we like to keep here as reference. There's more general studies around individual investor behavior problems. However, there are some very interesting studies as shown here about institutional investors oftentimes not making the most optimal decisions, maybe chasing returns or replacing investment managers within a portfolio too soon, just before they're about to bounce back. So having the right process and analysis can really help boost returns. Sometimes that involves patience and an artful analysis. So I want to thank you again for being here. Appreciate your time, and we'll take a look and see what other questions you might have. If there are any questions in the box, we'll take a look at that now.